The Computer Show, a new live one-hour TV star. Be sure to watch that star rise Wednesdays at 6, right here on TV 48.
You're watching KSTS TV 48 in San Jose.
Good afternoon and welcome to Ask the Expert, your opportunity to listen to what my guest has to say and then to give us a call a little bit later in the program. My guest this half hour is Bernard Blatte. Bernard Blatte is the managing general partner of Blatte and Weiss in San Francisco. And Bernard Blatte is here on behalf of U.S. Allied Development Corporation. And this program is brought to you by U.S. Allied Development Corporation. And with me now is Bernard Blatte. Thanks for joining us. I'm Skip Lindeman. Bernard Blatte is the former president of Hastings Law School. He is professor emeritus of tax law at Golden Gate University. He has a master's in tax law from New York University. And he is now and has been a tax attorney in San Francisco for the past 15 years. Welcome to the program, Bernard. Now, as an expert in tax and real estate law, why do you like historic renovations as an investment?
Well, historic renovations, Skip, are basically fixing up older commercial buildings, typically office buildings. So that means that not only do you get the interest deductions and the depreciation deductions that are attributable to real estate, you also get an investment tax credit equal to 25% of the amount that you spend to fix up an older building. Couple that with the general, what I consider to be profitability in the area of California real estate, and specifically San Francisco real estate, you have the best of all worlds. You have good tax benefits that involve the investment tax credit, which can be taken all the way to the end of the year. You have the interest and depreciation, and you have the income potential from renting out commercial office space, and the appreciation potential from having real estate in California, and again, specifically in San Francisco.
Okay, what sort of return can an investor expect on an historic renovation building in San Francisco?
Well, first, let me say that most of these types of deals are done in limited partnership form. And what the limited partnership does is allows the little guy, the people with $20,000 to $25,000, to invest in a project and to pool their funds so that they have enough money to compete with the big boys, the insurance companies and the banks, which usually take down the very lucrative projects. Now, given that, and you set up a limited partnership of this kind, you then have an opportunity to make a great deal of money. The more money you have, the more you are able to get a profitable deal. Now, in the past, we have aimed for, and we've been relatively successful in getting for our clients about 40% a year. Now that, of course, though, includes the tax benefits, the income, and the appreciation potential.
All right, thanks, Bernard. We need to take this break, and we'll be right back. My guest is Bernard Blatte. He is managing general partner of Blatte and Weiss. We're talking about historic renovation, and this is brought to you by U.S. Allied Development Corporation. We'll be right back with more of Bernard Blatte and historic renovation. Stay tuned.
When you buy a suit from Chris and Vince Cassera, you know you get a perfect fit every time. Chris and Vince Cassera, two top tailors from Italy, give you the personal touch with a lifetime guarantee in alterations. If you lose weight or you gain a little, Chris and Vince will do the needed alterations free of charge. It costs no more to get the best. So come in and see Chris and Vince Cassera, Saratoga and Kylie off 280. And ladies, you can get the best too at Chris Cassera's Marca d'Eleganza in Morgan Hill.
You're always in style at Chris Cassera.
Season's greetings. I'm John Pinto, Communications Committee member of the San Jose Real Estate Board. This holiday season, we're sponsoring our Food for Friends program. Any contribution of canned or boxed food that you can contribute will go to the needy elderly in Santa Clara County. Please make your donation to a participating realtor's office or directly to the San Jose Real Estate Board. For more information, you can call the San Jose Real Estate Board at 998 7300. Your contribution is greatly appreciated. Thank you.
Welcome back to Ask the Expert. My guest is Bernard Blatte. He is a tax expert, and we're talking about historical restoration or historic renovation. Now, Bernard, how does the investment tax credit work with historic rehabs?
Well, the investment tax credit is in and out of the law. It applies to the purchase of new equipment. It has never before, prior to 1978, applied to real estate. But what it is, and whatever it's given for, if it's given for real estate, is a credit, a dollar-for-dollar credit against the taxes that you owe. That means that if you spend $100,000 fixing up an older building, you're allowed a credit of $25,000. Now that means a $25,000 credit goes on your tax return and reduces, simplistically, reduces your taxes that you owe by $25,000. If you spend $10,000, it reduces your taxes by $2,500. In real estate, you're allowed to finance that, and hence you get the multiple write-offs, if you will. You put down, let's say, $5,000, the bank pays $95,000, and you still get a $25,000 credit against taxes due. Hopefully, when you sell the building, the bank will be paid off, and you put out $5,000, and you get an investment tax credit of $25,000.
All right, now, recently, I mean, this is going on in Washington right now. All this business of, well, are there going to be tax law changes? Treasury Secretary Donald Regan has had some proposals. What's that legislation going to do to real estate investments, and specifically historic rehabs?
Let's be real clear about something. This legislation that has been proposed by the Treasury Department has been in the works for somewhere between 8 months and a year. This is a very well thought out suggestion, ostensibly to simplify the tax law, but it makes radical changes in the type of taxes that we're used to paying. It is much broader than anything has been suggested. It will, for instance, limit or eliminate interest deductions, extend and limit depreciation on all things, not only real estate, and key to that is the elimination of the investment tax credit for all investments. The reason for this is that the emphasis of that law is to promote productivity in this country, is to promote people who work for a living, to give them a better break than the people that have money and are able to invest it. Because simultaneously with the elimination or the reduction of a lot of these deductions is the lowering of the overall tax rates. Now, theoretically, if they can adjust it correctly, everyone then will pay less tax but have less deductions. The net effect will be the same. However, with any change in the tax law, you're going to affect different sectors of the economy differently. And everyone says, in theory, it's a great idea, but when it comes to their particular area, they're concerned. What it will do to real estate, first of all, the investment tax credit, which is in the law now, which will probably be in the law next year because it's going to take a couple of years before the Treasury's proposals will be enacted, and they will be enacted in some form or another. The investment tax credit is put into the law and taken out of the law to encourage investment in particular areas. For instance, the certified historical rehabs that we've been talking about are because the government has made a determination it wants these older buildings fixed up and made more productive. Well, that's been incredibly successful and, as I described, incredibly rewarding to those people that have been doing it. But that credit comes in and out of the law. What is more important is the lengthening of the depreciation schedule, the attempt at an alternative minimum tax for everyone, and the limitation on interest deductions. That in the short term is going to be detrimental on all investments, but in the long term it's going to be very, very favorable to those investments which make money. What the government is doing by this type of legislation is encouraging the profit motive, and not just saying that we hope to make a profit, that we had a profit motive in mind. It will eliminate the argument. If you make a profit, you will be encouraged to make a profit. If you don't make a profit, there won't be that many tax deductions to take advantage of.
All right. Why do you like San Francisco specifically as an investment?
Well, I have been an attorney in San Francisco for 15 years, and a real estate and tax attorney. We have done a lot of our projects, and my projects that I have been involved with have been in San Francisco. I spent the first 10 years unwinding my clients' deals, and then we started doing deals, structuring the deals, putting together the accountants and the attorneys and everyone so that there are no surprises, there are no surprise fees. We like San Francisco, for instance, because it's in the state of California. The state of California has the finest economy in the country. The city of San Francisco has the lowest vacancy rate of all the major cities in the country. It sometimes ties with New York and possibly Boston, but it is right up there no matter what happens. During the recent recession, when Houston was at a 25% vacancy rate in its commercial office buildings, San Francisco went from 0 vacancy, meaning nothing was available, all the way down to 7%. So it is a good, stable place. It is also the economic center of the West Coast. We, in those high-rise buildings, don't make farm equipment. We push paper. And there is always, it seems, a need for people that push paper. The euphemism is the service industry. But they are enabling the rest of the country to do what they have to do.
All right. Thanks, Bernard. We're at area code 408-946-5353. If you'd like to ask Bernard a question about historical renovation or restoration, please let us hear from you. 408-946-5353. We're going to take this break, and then we'll be right back. Stay tuned.
Win a Macintosh computer in the TV48 Vision of Silicon Valley survey and giveaway contest. Prizes include a Macintosh computer valued at over $2,000, a $200 gift certificate to Chris Casera Clothiers, and a $100 gift certificate to On the Ritz Restaurant. To enter the contest, call the TV48 studios during business hours at 408-946-3400, or send your name, address, and phone number on a postcard to Channel 48. Post Office Box 5999, San Jose, California, 95150. All contestants will receive a TV48 viewer survey. Your views matter with Channel 48. Entries must be received by Thursday, December 13th. Winners will be announced during Institutional Investing, Friday, December 14th, between 1 and 2 in the afternoon. Enter right now and be a part of Channel 48, your interactive television station.
Welcome back to Ask the Expert. I'm Skip Lindeman, and my guest is Bernard Blatte. He is the managing general partner of Blatte & Weiss in San Francisco. We've been talking about historic restoration or historic renovation. And this Ask the Expert is brought to you by U.S. Allied Development Corporation. This is the logo. You can see that. U.S. Allied Development has lots of questions in this brochure. If you'd like to have this, you may certainly have it, and you may call the number. You'll see it on the screen later, but it's area code 415-391-5137. This little brochure says what is historic restoration, what is a certified historic structure, all sorts of questions. What is the amount of investment tax credit on historic restorations? Will the investment tax credit be recaptured? Anyway, lots of questions on the tax status. Now, we're here at area code 408-946-5353. Bernard, what's your opinion now of the current status of tax shelters in general?
Well, the current status of tax shelters in general has been obviously affected by the Internal Revenue Service's chagrin at a number of deals which have been entered into only for the tax benefits. The problem that you would suppose is a real one. You have people entering into transactions simply to gain the tax benefits and not for substantial economic reality. The IRS has chosen to call these abusive tax shelters. And they're quite obvious. The ones that have no chance of making money, the ones that are guaranteed to perhaps return to you a third of the money that you originally invested back. Those are the kind that the government has been and will continue to be after. The proposed changes in the new laws seek to treat those problems with a broad brush, seek to eliminate some of the tax benefits. The ability of a tax deal to make a profit cannot be, you cannot underemphasize that. The deal has to make a profit. If it makes a profit, you don't have any questions about the tax benefits.
All right. We're at area code 408-946-5353 if you'd like to ask Bernard a question. What sort of real estate investment do you personally recommend?
Well, far and away, the best investment for real estate has been and will continue to be, even under the new law, your own home. That is far and away the best. Second to that, however, when you go into other areas and when you're looking for a real true investment property, I like commercial office space, commercial office buildings, commercial retail. The reason I like that so much is that a commercial space is more valuable to a commercial tenant. In other words, he gains an economic worth out of that. There also, it is to be remembered, is no commercial rent control. The reason is that the government likes to allow the free play of free enterprise.
All right, let's go to your phone calls now. We're at 408-946-5353. Line 1, you're on the air.
Yes, Mr. Lindeman. I'd like to ask Mr. Blatte, historically, when legislation such as we are now facing as far as the taxes are concerned, if you get into an investment of real estate, are in two areas. One of them is in the personal home that you own, and the second one is in commercial real estate that you might be interested in investing in. Are these particular situations, as far as the government concerned, usually allowed to go ahead and run their course? In other words, the investment for 5 years is allowed to go ahead and run, and then the new taxes are then put on any other investment that you made?
That's an excellent question. It really brings up the topic of when, if the new proposed tax laws are enacted, when will they be made effective? Under the normal circumstance, tax laws are enacted as of the date they're passed by the legislature, which won't be for a couple of years, and they're phased in or they're made prospective. In other words, they probably will not affect deals under a binding contract today. The second question that you sort of hinted at was, what about personal family dwellings? And it is interesting that under every aspect of the proposed changes in the tax law, the deductibility of interest for personal family dwellings is untouched. There is something in this country that is sacrosanct about a person's home. And
part of the American dream.
Part of the American dream.
All right. We're at 408-946-5353. If you have a question for Bernard Blatte, maybe we should say for our audience, just what is historic renovation? I mean, you think about old buildings and making them new again.
It's very simple. It is substantial, meaning fixing up, spending more than 5% of the total cost of the project, which is not hard. Renovation, fixing up, painting, whatever, of an older building which has historical significance or which fits within one of the criteria that the government wishes to be fixed up. Fixing up can be nothing more than a paint job, or it can mean as much as rebuilding the building internally out of structural steel rather than just painting it. Anywhere in there is an expense. That money which is spent, whether it's spent by the investor or whether it's spent by the bank loaning money to the investor, is given to the investor as an investment tax credit. In other words, if the investor spends, again, $10 and a bank spends $90, you've spent $100 fixing up the building, the person that is responsible to do that gets on their tax return an investment tax credit of $25. It is to encourage fixing up older buildings.
And now you said that the IRS wants to stop abusive, whatever abusive means, tax shelters. It sounds like what we're talking about here, you emphasize the possibility of making some money, and so this is really perfect as far as the IRS is concerned. Wouldn't you say?
The first time I ran across the word abusive, because the word abusive is not in the Internal Revenue Code. The word abusive first appeared in a Sylvia Porter article in 1978, and I looked at that like everyone else looked at that and said, what is an abusive tax shelter? Well, then it was further defined to mean something that does not have substantial economic reality. Well, those types of definitions will drive you nuts. What you need is something that is operable. One thing that we do know is that if the transaction is entered into for profit, it's not abusive. But then you have to convince the IRS that it was entered into for profit. The best way to do that is to make a profit. That's why real estate was categorically exempted from the at-risk rules, the rules that said you had to be personally liable. In real estate, you get a lot of the tax benefits even though you're not personally liable to fix it up. The reason is that there is a prejudgment by the Treasury Department, which enacted the Internal Revenue Code, and by the IRS, that real estate's profitable. So wider latitude is allowed in the deductions. As to what is an abusive tax shelter, it's still unclear. I do know that if it looks and smells like an abusive tax shelter, it is. On the other hand, tax law is like sausage. People like the results, but they don't like to see how it's made.
We're at I like that. We're at 408-946-5353. If you have a question for Bernard Blatte, we're talking about historical restoration by U.S. Allied Development Corporation. Bernard, you sort of touched on this before. How did you get involved in real estate? Because your own clients, is that it coming in?
I started off as a real estate and tax attorney in San Francisco, practicing as I started off 15 years ago. And for the first 10 years, I sat there passively and reviewed my clients' deals. They went off, did their own deals, and I found myself after that period of time really unwinding a lot of their projects. Anyone that says you can't lose money in real estate doesn't know what they're talking about. You have to be very, very good and very experienced, and you have to have the knowledge of an attorney, the knowledge of a CPA, the knowledge of a real estate broker. You have to know how to negotiate, and you have to predict the course of the economy, and after all that, you can still lose. But my clients would go out and do their typical deal, and a typical deal very easily done is a no money down deal. In other words, buy a condominium, put no money down, and no problem, you get the tax benefits. The problem is, after they buy it, and after they're sitting on negatives of, let's say, $300, $400 a month, they find that the no money down deal's biggest problem is that you have to, at some point in time, pay the rest of the money. So although in the first year it's very easy to get into, it's very difficult to get out of. In real estate, you look for a very high rate of return. You don't look for the average 6, 7, 8%. You look for 25, 30, 40% because real estate is a risky adventure. It is not as safe as a T-bill or a T-bond, and you can get 10, 11% every day of the week in those investments. The only thing is, in those investments, you have two things. One, the government will never pay you more than the face amount of that bond when you cash it in, whereas in real estate, you can take advantage of the appreciation. And two, you have a chance of making good current income.
Okay, thank you very much, Bernard. That's Bernard Blatte. We've been talking about historic restoration, historic renovation. You want more information? Please get in touch with the U.S. Allied Development Corporation. You'll see the number on your screen. I'm Skip Lindeman. Have a nice day.
This is a test.